Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 20th, 2016. This week, the stocks are attempting to stabilize after about 3 weeks of selling. We'll look at some of the sectors which could provide, protection during the bear markets and stocks, and whether or not you can really hide in those sectors. The bonds pulled back from all-time highs, and the dollar looks like it may have gotten a breakout. We'll look at it in more detail. And of course, the commodities are inversely related to the dollar, so we'll look at the gold, oil, and natural gas. And finally, we'll finish up with a bullish looking commodity that I don't normally talk about, but this may be an interesting bullish setup. Alright, this is S&P 500 ETF SPY, kind of like our proxy for the market. So not really much has changed from last week. Last week we closed below the 50-day moving average, and then we came above it, below it. Anyways, so far the stocks were not able to close above the 50-day moving average. You can see that it is acting now as sort of a resistance, and then even here on Friday, which was a pretty strong day, by the way, because we had a gap up and then continuation higher, but throughout the day the stocks did sell off, so there was no close above the 50-day moving average. So there is a battle going on to recapture the 50-day moving average, and it could really go either way, but maybe we will get a short-term rebound, possibly to this area, about 207, maybe even higher to 208 here. Now, I still think that generally speaking, this is a bearish, stocks are bearish, and I'll continue and I'll show why that is. So maybe we'll get a little bounce and then turn around and continue lower. Down below here, I already showed this in the past few weeks, really no change. We had a breakout in advanced decline line, but no breakouts in on balance volume and advanced decline volume lines either. So again, we're looking like we're moving sideways, but my bias is bearish, so we could go either way basically, but I'm thinking that we will eventually roll over and we will retest at the very least these highs and possibly even the lows from February. This is the actual S&P 500 index. The previous chart showed the ETF SPY with dividends added back into it. Without the dividends, we made an all-time high here, or rather back here in August of last year, or I meant in July here. And then since then we were not able to recapture those highs, even after this pretty wild swings, really. And I went back and I looked through pretty much entire history of Dow Jones Industrial, going back to 1900, and I really couldn't find any example of similar wild action. And this was already pointed out by many commentators that this is very much unprecedented market action, and we're sort of in an uncharted territory. And most likely this is because of the constant interference from the central banks. But in any case, per my trading system, I have a market breadth index, which I developed as my own index, and I look at this index helps me decide whether or not the stocks are in a bull or bear market. And per this index, we did enter a bear market back in September of last year. So this was a counter trend rally in my opinion. So again, for now, I'm treating this rally of the February lows still as a counter trend rally. If we get an improvement in market breadths and we get this line close above this green line, then I will consider stocks to be in a bull market. But as of right now, I'm still treating this as a bearish security. Down below here I showed S&P 500 percentage of stocks above the 20-day exponential moving average. So we got a dip below the 40%, and you can see that when we were here in November, we got a dip below the 40% and then immediately popped back up, and we got a rebound. So we could get something very similar to what we had here, and get a rebound. And like I said, maybe we get a rebound to maybe around here to 2080 or so. Okay, that's it for this chart. So this is also S&P 500 ETF SPY, unadjusted without the dividends, and this is a close-only chart. And this chart you can clearly see a downtrend with lower highs and lower lows. This bigger, thicker line here connects the all-time high here to a recent high. But the thinner line here connects these peaks here, and looks like we got a breakout here last in April, but then we closed right below it. So it's entirely possible that we're going to get a retest of this line, of this trend line, and it's coming in here around 206 or so. But again, as I said, I think the bigger resistance is up here at 208 and change. This is the broader index. It's a New York Stock Exchange Composite Index. This one has been in a downtrend for longer than the S&P 500. Started here in June, all-time high, with a breakdown here and then here. But also it's much weaker looking than the S&P 500 because these lows are below this September low, so we made an even lower low compared to the S&P 500. And then we had a rebound similarly to S&P 500 that took us basically to November highs, but so far we were not able to break above them, and so far the price was rejected there, and we came down to below the 50-day moving average. So same thing as the S&P 500. I think we're a little bit oversold, and we may get a rebound here to maybe 1040 to this level here. And if we fail there, this could be a very obvious setup for the shorts to come in, and then we'll get a potential retest of February highs or even February lows. Down below here we have new highs less new lows divided by total active symbols, and I showed this before. We closed below the negative 10% here, minus 0.1 is 10%, back in July of last year, and since then we were not able to close above the positive 10%. In fact, you can see that we were getting pretty much new highs here, new highs, and then just recently we started getting new lows, outnumbering new highs. Again, the volume has been lacking on this rebound, and we did not get a breakout just yet. The number of stocks participating, of course, did get a breakout. And then, as before I showed for the S&P 500, looks like we closed below for the percentage of stocks above the 20-day EMA. Looks like we closed below the 40%, but now we are rebounded. So it's kind of similar to what we had here. Let me see, where was it? Right here in November. Looks like we closed below and then rebounded. So some sort of a bounce back is normal and to be expected, but I think this is a bounce back within a bigger downtrend. Okay, so this is a chart. It's pretty busy, but let me try to explain what I'm trying to say here. So this is a chart of several funds, S&P 500, real estate, energy, consumer staples, and utilities, and they're all graphed together on the same chart. The reason for that is I wanted to make a point and say that basically stock funds and stocks in general are highly correlated. In other words, they zig and zag together. in a similar manner. There are some differences, of course. You can see, for example, here XLP, the staples underperformed while the real estate really outperformed. But in general, they were both going up in price. And then here, when we tapped out in 2008, first the real estate tapped out in 2007, and then the rest of the market sort of rolled over. But they all rolled over. That's what I'm trying to say, is that during the bear markets, and I actually showed this before, during the bear markets, really there's no place to hide. If you think you're going to be hiding in consumer staples, you might lose less, but at the same time, you will still, have losses on your books. So down below here, I have correlation coefficients, and you can see that this is a correlation coefficients of funds that I mentioned here. And by the way, I want to say that these four funds, the energy, utilities, staples, and real estate, they have the least correlation to the general market, which is S&P 500. The other funds like consumer cyclicals and the financials and industrials and technology, they are even higher correlated than these four funds here. So these four are the least correlated of the sector funds. And you can see that the correlation coefficient spends most of its time in the positive territory. There are some forays into negative territory, but by and large, everything is correlated. And that includes, by the way, real estate, which some people think that they are uncorrelated assets. They are highly correlated. All right, and then now let's go into each individual of these three sectors rather. Okay, so let's go through some of the individual defensive sectors, and this is utilities, of course, the most defensive sector out there. We had a breakout here, an all-time high, but then we had a pretty strong pullbacks, and these pullbacks were on high volume as well. So maybe we're getting some sort of a selling or the buying climaxes. Also, same thing here, we're getting some pretty strong pullbacks. For my taste, utilities are not exactly the most defensive-oriented fund. The most defensive thing you can think about is, of course, cash. The second most defensive thing is possibly bonds, a short-term one. Here down below we have bullish percent index for utilities, and you can see that it was basically at almost 100%. So in other words, almost 100% of utilities are on a point and figure chart buy signal, and this is certainly overbought. So some sort of a pullback is in order. Maybe we'll get a pullback to the breakout level for utilities, and this where a 200-day moving average coming in as well. But like I just mentioned, during a true bear market, when everything starts selling, I think utilities will also get sold. This is real estate, also a defensive sector, or some people think that way. This was a 52-week low, and now we had a 52-week high. So this is a very difficult, wild swing, really. And I think this is because of very low interest rates. And now looks like we hit the 52-week high, and we're pulling back. We're pulling back to the support level. Now, we could say that this is a beginning of a head and shoulders. So maybe we get another bounce and then possibly head lower. And if that's true, then we'll break the support here at around 75, maybe even 74, 72. If we do break the support, and like I keep saying, real estate is part of the market, and correlations are high, so most likely the general market will also be heading down by then. XLP, consumer staples. Similar picture with consumer staples here. looks like we're running up to 52-week highs here, but we had some couple of bouts of rather strong selling. Especially you can see that this volume here is the highest volume in 6 months. So maybe we're getting some sort of a buying climax, maybe even beginning of the distribution already. Same thing here. You can see those two large volumes, and this is pretty strong selling here. So again, as I said, if this general market rolls over, I don't think the utilities or the staples or the real estate will be spared, because they're all stocks. They will all get sold. So this is just something to keep in mind. And if you're trying to pick and choose which sector you're on, and the real bear market will kick in, then most likely all of the sectors will get sold. Okay, so this is TLT, 20+ year Treasury bond fund. So last week we're getting close to breaking out above these levels here from April, but we didn't. We kind of bumped against this trend line and sort of pulled back, and then during the Fed announcement, we had strong selling in treasuries. Since then, the price more or less stabilized, but this is still, these 2 days are still inside the big candlestick from Wednesday. So some sort of a resolution will come once this range is broken to the upside or to the downside. The selling was on high volume, so this is definitely a concern. If you're a bond bull, and I'm a bond bull, I still think that bonds are bullish in the long term, and even you can see that this is StockCharts technical rank. That, relatively speaking, compared to the universe of other exchange traded funds, this is still in a top 10% of the funds. So there's not much out there that's going up, and this is one of those funds. On a longer term time frame, this is TLT again. On a longer term time frame, we can see that this pullback, if you look at it, this is a weekly chart, was not in a very high volume, comparatively speaking, to other weeks. For example, here, beginning of May, we had a high volume advance versus this low volume pullback. So, again, maybe we'll get a little bit of a pullback, but generally speaking, I still think that this is a bullish fund, because it's all-time high, and this is quite bullish to have all-time highs. And a normal consolidation, sideways consolidation, or maybe slightly down, is absolutely normal. This is a diversified bond fund, aggregate bond fund. Similar picture to TLT. This one I think it's a little bit even stronger than TLT, because it was already at all-time highs for a while, and it's advancing even steeper than the TLT. But we did get a pullback during the Fed announcement of a possible rate hike. Not a very good looking candle here. Maybe we're building a rising wedge, and maybe we'll get a breakdown below the 110.31. But all-time highs are bullish, so if we do get a pullback, maybe to the breakout level, maybe even to this breakout level, that could be a nice buying opportunity. We'll see where it goes. And on a longer term time frame, this whole week is right here. This is half a percentage point. So for bonds, that's quite a bit, but again, you can see that the volume on this pullback was quite low, and you can see that advancing volumes were much higher than this pullback volume. All right, let's switch gears a little bit. This is US dollar. Pointed out this is a daily time frame US dollar index. I pointed out this big hammer candlestick, and I said several weeks ago that this was basically a picture-perfect hammer candlestick with a follow-through, just beautiful continuation higher. And this was next chart. I'll show that this was actually at support. Clearly, this was not a bear trap. This was this was a bear trap because we had a break below support and then immediate reversal. Now we are actually above the first resistance level and above the 50-day moving average. So that's certainly a good sign for the dollar index. Okay, so on the weekly time frame, you can still kind of make a case that this is a cup and handle formation, and we had, you know, 3 white soldiers here, just picture perfect candles, and this is a breakout above this level that I just showed. As I said, this was a support level at 92.52. We pierced through it with a hammer-like candlestick, both on the daily and the weekly charts, and we rebounded. So the dollar seems to have held support for now. Some sort of a, you know, pullback is certainly in order. But for now, I think we could continue, you know, maybe sideways and then continue higher. So here we have actually the yen may have reversed of the 52-week highs, and if this is the case, then we could see even stronger gains for the dollar itself. And of course, strong dollar is going to put pressure on the various commodities. Okay, this is a long-term chart. This is a weekly chart for gold and the US dollar, and I graphed them on the same chart. So green is the US dollar and the yellow is gold. This is just to illustrate the point that gold and the dollar are strongly negatively correlated. And down below here I have correlation coefficient, and you can see this is a very strongly correlated, inversely correlated assets. If the dollar goes up, gold goes down. Not always, but quite often it does so. In fact, if I was betting money on it, I would say that this is certainly a strong correlation. Currently, it's at negative 0.86. So that's the breakout from the 2014 level I showed, and now we're right there. So again, if we continue higher with the dollar, gold will certainly come under pressure. And here is gold on a daily time frame, and you can see quite clearly that dollar was going up this past several weeks, and gold was correcting. Well, that makes perfect sense. Now, I think we got a breakout, and I think we have a new bull market in gold, but it will actually really strongly depend on the dollar. And I think that if the dollar continues higher, this entire breakout may be called into question. So that is another piece of information to keep in mind. In fact, this chart of GDX, Gold Miners ETF, this selling volume is the highest ever recorded. And I mean in the entire existence of this ETF. And clearly this is the highest volume in the recent history, and this is about, what is it, 7 months chart. So there was a big drop here. This was during the Fed announcement that they are going to be raising interest rates in June, which in turn means that the dollar most likely will appreciate. If the dollar appreciates, gold will come under pressure, and gold miners together with it. Now, gold miners had really a tremendous run from this bear trap here in the beginning of this year, and this is over 100% move. So certainly a very strong move, and it is entitled to some sort of a correction. And so I put in a Fibonacci retracements from this 52-week high to the all-time low here. So a normal shallow retracement would take GDX back down to 2089, or even deeper retracement would take it 19, and then a certain 17. If it comes down here to about 1760, then this entire breakout may come into question. So again, this all really depends on the dollar, because gold miners are tied to the gold, and gold itself is tied to the dollar. So oil had a very strong run off the multi-year lows here. This is actually USO, United States Oil Fund, but oil has a similar pattern to USO. This one just shows a much clearer and nicer pattern. You know, pretty strong run here. Now we're basically at the broken support right here, at around, what is it, $12 for USO, and we're rising in a rising wedge sort of formation, and this is clearly a downtrend in security. So if we run into, and this is resistance, so we're basically there. No wedge break. If we get a wedge break, we'll say if we get a close below, maybe here, maybe below 1060 or so, then on a weekly basis, by the way, this is a weekly chart, then certainly we are could continue lower and retest the February lows. Okay, it's a similar pattern for UNG, United States Natural Gas Fund. You know, not exactly the best vehicle for investment, but it's okay for trading and to you know, read the chart as well. So you know, well, this is actually all-time lows, but for the natural gas itself, these are multi-year lows here in February, March, and then a rebound. So this is a, you know, a rising, maybe a rising flag, and we may have already gotten a wedge break here this week. We'll see if it pans out or not. If it does, then certainly new lows are more likely than continuation higher. There is resistance, you know, up here around, what is it, 740 or so, and then further up, if this is not yet rising wedge is not yet done, we can see maybe a little bit higher prices. But maybe we already got the rising wedge break, so continuation lower is certainly possible. And finally, one commodity I wanted to point out that I don't normally cover, but it kind of caught my attention. It's an interesting pattern. So this is cocoa, spot price daily, and you could trade the same this commodity with the ETF called NIB, NIB. It basically follows the price of cocoa as well. But in any case, you know, I can make a case that this is a bullish security because these are 52-week highs right here. And then we pulled back rather hard, but we did not break this support from 2015. By the way, this is a weekly chart from 2015. And then we rebounded, and we're making a series of higher highs and higher lows. So potentially, if we hold support here, this could be an interesting opportunity to go long. And my subscribers basically are going to get a signal emailed to them once I'm going to buy it as well. So interesting chart, potential bottom information here, and maybe a continuation higher. That's it for this week's recap. Thanks for watching. Have a nice day. Please stay tuned to find how to find us on the internet. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading, and various aspects of risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube stacked with accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.